Hi Digital Chiefs, welcome back. Today I'm going to cover a question I get quite often from very early stage founders. Will you sign my NDA? Now this question often comes about from founders who are very early stage, brand new to startups, and really don't understand the perspective of the investor. I want to kick off this video with a small disclaimer. As many of you know, I am not a lawyer, I am not a financial advisor. All I'm doing is really sharing my perspective and my experience as an investor over the last 10 years. I don't know your personal circumstance. Please keep this in mind. This is very general advice. First of all, let's go through some of the basic practicalities of being a venture investor. Imagine you are a successful investor. You open your inbox every day and there are hundreds of pitches there, all roughly sounding about the same. One email mentions their technology as innovative, world-changing, and disruptive, and then signs off with asking for an NDA. Meanwhile, you've got 10 other emails in there. A couple of the emails actually go into a lot more detail about their startup and their technology, enough to actually intrigue you as an investor, and so you take the next step and set up a meeting with the founder. So hopefully you see what I'm getting at here. Often there's just not enough time in the day to go through all the pitches in the inbox, let alone properly review them and reply. In addition to this, an active investor will be doing due diligence, interviewing founders, and managing their existing portfolio. Anyone who spent any time trying to fundraise and get an investor's attention will know that it is incredibly challenging unless you've got a warm introduction, unless you've got a successful track record. Good active investors are simply too busy writing investment checks. This is why investors hate it when founders bring up the NDA way too early on before they've actually shared anything about themselves or what they're working on. Many investors will never sign one at all. It is one of those first red flags to an investor that a founder is brand new to startups and is really focused on the wrong thing. Look, every founder thinks their baby is unique and innovative. I've been there myself. The fact is, with hundreds of pitches in your inbox, this is rarely the case from the investor side. We see so many of the same problem and solution sets that it is quite rare for us to see anything incredibly unique, unless you are working on some sort of deep tech. The reality is many of us just glaze over the emails in our inbox. We scan through, spending less than 60 seconds on each email. This is why we invest in less than 10% of the pitches we receive in our inbox. You'll often hear the phrase from investors that execution is everything. That means ideas are actually worthless to us unless something is done about it. That means who you are, your expertise, your energy, how you'll actually put the idea into practice is more important to the long-term success of a business than the idea itself. Founder who is asked for an NDA too early is really misunderstanding what is essential for a business to succeed. Number two, investors are typically not in the business of stealing ideas. If we look at the Investopedia description of what an investor is, then you'll see that their goal is to deliver a financial return. I mentioned this in one of my previous videos, 5 mistakes when pitching investors. Check that video out once you finish this one. Investors are not looking to build a business. They're investors, not entrepreneurs. The only real risk that I've seen, and this is not exclusive to investors, is the sharing of information to potential competitors, i.e. startup founders that they might know or have invested in. For those of you who've taken my online fundraising course, you should know to actually do quite a bit of research on the investor and their portfolio before you go ahead and pitch them. While you may not know of investments that they currently have in transition, by keeping your round time bound, you will be able to limit the amount of exposure. Again, if you've taken my fundraising course, you'll know how to keep the momentum up so that you can close the round faster. The third reason why investors don't sign NDAs is that they are rarely enforceable. Typically, cases of stolen IP come from previous employees who've moved on to working for a competitor. It is extremely rare to have IP cases brought about against investors, and even fewer that are successful. This is because most early stage founders are strapped for cash and they're strapped for time. Enforcing legal disputes chews up both. So unless you have the funds to sue over an IP breach or have very deep patent protectable IP, then frequently your NDA is just not enforceable. Again, I'm not a lawyer. I'm simply sharing what I've seen in practice as a VC over the last decade. Another consideration is how quickly technology is evolving these days. What might have been incredibly unique and protectable is quickly outdated, and so again, the enforceability might be a challenge. Number 4, another reason why investors don't like to waste time on NDAs is every single legal document might be slightly different. They simply don't have the time to review every single NDA and or spend the time and money to send it to their lawyers. VC funds will typically have their own NDA if they're interested in pursuing a startup. So you're the one spending the time and the money to review those particular clauses and make markup changes. So that's an additional cost for the founder at early stage. This is simply just not a wise way to be spending money, regardless of if you're a founder or an investor. The mentality of most investors, frequently subconsciously, is looking at how they can turn $1 into $10. So with that in mind, why would an investor sign an NDA when they know nothing about you and nothing about your startup? Put yourself in their shoes. Would you be willing to spend the time and the money to review an NDA for every single investor that you speak with? Typically, you need to speak to anywhere between 20 to well over 100 investors. That time and cost can add up pretty quickly. So ideally, you want to be at a stage where the investment is as close as possible to actually happening before you bring up the NDA. I'd say at least 70% sure. Which leads me to, are there actually circumstances where the NDA is appropriate? Now, after talking at length about why investors don't like NDAs, there are situations where it is appropriate to bring it up. Generally speaking, you should not be sharing anything that is particularly sensitive early on to get the investor's interest. That means no sharing of codes or trade secrets until at least the term sheet has been signed, and definitely prior to sharing the deal room. I will make a point about the differences I've seen between the regions. In the US, frequently NDAs and term sheets are signed hand in hand or very closely together. This is prior to access to the deal room and prior to really formal due diligence. In APAC, however, I've seen things being a little bit more fluid, where founders are sharing deal rooms prior to term sheets and NDAs. I do not recommend this. A discussion of the NDA and term sheet and a commitment to signing both should be the bare minimum for access to the deal room. Otherwise, how will you know if this investor is actually interested in buying as opposed to simply shopping around? Investors should know that the term sheet is non-binding and that NDAs, again, are rarely enforceable. So it should be a bare minimum for the investor to want to sign both as a way to indicate some serious interest. I know when I'm investing, I would not be looking at signing both unless we were at least 70% sure to closing the deal. The deal room should confirm everything the founder has been presenting and not show up any particular red flags that weren't already shared in the past, such as bad debts, unpaid taxes, lawsuits, or simply figures not quite matching the initial pitch deck. Out of the 50 deals I've done, maybe one or two off the top of my head were really misrepresented in the due diligence documents. And that broke the trust of the relationship. It was really difficult to go ahead with those deals because of the misrepresentation. So hopefully you understand that if an investor completely refuses to sign a term sheet or an NDA prior to accessing your deal room, it is a little bit of a flag for you to keep in mind. Professional investors, i.e. those actually writing checks, do not have a lot of time to be reviewing deal rooms, even if they get one of their junior analysts to do it. Going back to thinking in numbers like an investor, they should be okay to invest $1,000 to review an NDA if they're going to make a $25K investment. If they are not serious about making that investment, then they will not be spending that time or money. I've very strangely seen VCs, mostly corporate VCs in APAC, spend the time going through deal rooms where founders have shared them without NDAs. The vast majority of these deals did not go through. So I'm not sure I understand how investors have time to do that. If you are a founder or a VC who has experienced this, please let me know why this happens. I can't seem to make sense how a VC would have the time. In summary, you can talk about your key features and business operations that gives you an edge without outlining step by step and without needing the NDA. The most professional VCs already have the NDA and term sheet templates built into their process because they also don't want their terms disclosed. The main thing is to get to a stage where both parties are equally interested in what the other has to offer and that the NDA is a natural progression of discussions, as opposed to the founder putting up a brick wall even before the investor has established interest. Hopefully that has helped you better understand investors. Let me know if you've had any success with NDAs. Have you had any funny comments come back when you're asking for NDAs from investors? Perhaps no responses back. Have investors been happy to sign them? At what stage? Have you noticed any differences between angel groups, VCs, and accelerators when it comes to NDAs? I'd love to hear about your experiences on this. Happy fundraising!